Welcome to the Zandbergen Report, where wealth strategies and pop culture collide, featuring your distinguished host and certified financial planner, Bart Zandbergen.
Welcome to our show of Dream Chasers and Wealth Makers. We are thrilled to be back in the studio today with a new episode of the Zandbergen Report. I'm proud to bring in the movers, shakers, and difference makers who are passionate about sharing what they have learned and what you need to know today. Today, I am very pleased to have, I'm going to just call it Ben Squared. We have Ben McMillan, CIO, and Ben Jacobson, Managing Director of IDX. Gentlemen, welcome to the show.
Thanks for having us, Bart.
Sure.
Thanks for having us.
Sure. So if it's not obvious, we have one Ben in studio and one Ben in studio via Zoom, but that's okay. So as many of you know, we have asked, what's the most important thing you want to hear about these days, and what's of most interest? And without a doubt, the subject of crypto, Bitcoin. Give us something on that. So today we're giving you what you want. Today is all things crypto, all things Bitcoin. So these gentlemen here seem to know a thing or two about crypto and Bitcoin. So what I'd like to do is first start with Ben Jacobson. Ben, a little bit about your kind of what got you into crypto world, and then Ben, we'll go to you, Ben McMillan.
Sure. Well, for me, I really grew up kind of in the quantitative asset management arena, really meaning more so we don't just wake up one morning and think, hey, something's a good idea. Rather, we build a system and a rules process around it such that can help inform us when's a good time to be participating versus not participating. And I was doing this for a commodity trading advisor. So we were trading 145, 150 different markets across the globe with all the same very much rules-based, risk-driven approach. So I was turned on to Bitcoin by one of our clients, I want to say 2013, 2014, and originally just kind of started trading it on my own with some of the things that we learned kind of in the quantitative space of managing risk, because as we all know, it's a very volatile, very up and down type of asset class. So for us, managing risk was always important for what I was doing in kind of my professional life. So I figured I took that same thing to actually trading cryptocurrencies, and at the time it was primarily Bitcoin. So from there, kind of continued to trade it on my own here and there, have some ups, have some downs, just like anybody else I think in that space. Yeah. But it really wasn't until I started working with Ben where he was kind of turned me on to, all right, well, let's apply some of these things that we've used from other aspects in wealth management, whether that's stocks, whether that's bonds, whether that's commodities, but start to apply them to things like crypto. All of a sudden, I stopped trading my own personal money and just kind of had it in our more of a risk managed type of approach there. So I'd say early on more so than a lot of others, but have definitely learned a lot along the way, and I'm still continuing to learn as we go along.
Yeah, I'm sure you do. And we're going to talk a lot more about your company as well before we get through here. Ben McMillan, how about you?
Well, like you said, I mean, I've got people who, like my little cousin who has no business whatsoever taking any kind of risks, is texting me asking what kind of crypto you should buy. And the last time he did that was at the absolute top in 2017. So we've definitely, it definitely feels familiar. For me, it was interesting because I was already out of school, and I remember this guy telling me, actually, it was the first boss I ever worked for, who was a really sharp guy, I mean, a proper genius. And he said, hey, have you heard about Bitcoin? This is like 2011. And I was like, no, I have no idea what you're talking about. So he sent me this Satoshi paper, and he's kind of explaining it to me. He had to explain it to me like 3 different times. I was like, all right, that's super interesting. And he's like, yeah, he goes, it's actually trading. It's trading for like 20 cents. He's like, he goes, you can set up a mining node to, facilitate the kind of decentralized computational power, and you can earn Bitcoin. And I was like, all right, if you earn enough, pick up enough quarters, it'll be worth something. At that time, we did the math, and it ended up being like 60 cents a day of electricity to mine, 50 cents of Bitcoin. But of course, hindsight being 2020. What was interesting was, for me, the social, back then, the blockchain concept was clearly novel. The kind of the trustless, the permissionless custodial function that it provides, was interesting from an academic perspective, but it was difficult to see how that would translate to the real world. And what was kind of fascinating for me to see in those early days was, and I remember actually reading an article in Wired magazine about the Silk Road, the black marketplace, where Bitcoin was, actually basically their central currency. And, that was kind of fascinating from an economic perspective, was that, facilitated this semi-anonymous, Bitcoin's not anonymous, but, semi-anonymous, very easy exchange of wealth across country borders. That guy ended up getting taken down, the moderator of that site. I know there's a movie out there for those that haven't seen it. It's totally worth watching, but the way the FBI took him down was absolutely fascinating. It's worth reading the Wired article if you have it.
Don't tell us yet. I haven't seen it. Don't tell us how it ends.
No, it's totally worth it. But again, this is circa 2011, 2012. I think he was arrested in 2013. Bitcoin was still very much a novelty. It was still very much the domain of kind of, the black market, the Silk Roads of the world. But it was interesting because going into 2017, you started seeing more and more real world use cases. I remember I worked right off Central Park in New York, and there was a bar, in 2015 that started accepting Bitcoin as payment. You started seeing it pop up. And then, fast forward to today, the obvious question is, well, what's different today from 2017? How do we know this isn't just, kind of more tulip mania? And, the big difference we see is, back in 2017, it was purely speculative. The use cases for Bitcoin were still kind of largely academic. There wasn't a lot of real world, transactions happening on the blockchain. Fast forward to 2020, and so-called DeFi, decentralized finance, has absolutely boomed. I mean, there's the use cases are here. There's tens of billions of dollars transacting on them, and it's very clear to see how this technology is going to be disruptive across payments, supply chains, just everything. The United Nations has a pilot project looking at tracking identities for refugees using blockchain. So it's a sea change in terms of utility from what we saw last time around. But again, I still got my little cousin texting me asking me, what should he buy now? So.
All right, so we're going to kind of bring it back a little bit and then bring it back forward. So I think it would be really interesting for those who don't know. Let's break it down to what is a Bitcoin, what is cryptocurrency, and then even blockchain. So just a brief definition of each.
Yep. So Bitcoin is just a representation. You can think of it as kind of a unit of compute on the blockchain. And so the blockchain itself is really the crux. And all it is just a decentralized database. And so as opposed to having a database, at a bank or within a company, which is, centralized on servers or on the cloud these days, Amazon AWS, users across the world, the network, contribute their computers, these Bitcoin nodes. So, you download a set of software. It's the same across everybody's computers. And that software has on it protocol for sending the transactions back and forth in a permissionless way. And what that means, these transactions, being reflected by the Bitcoins themselves. And what the way that works, the way it's permissionless, is you have the network essentially verify the transaction. So as opposed to having, and this is really kind of the key issue. So as opposed to having a trusted intermediary like a bank or whoever, a custodian, somebody who's watching the settlement, ticking in a ledger, who owns what, the network is doing that in a distributed fashion. And that takes computing power. In exchange for that, each portion, when you send a Bitcoin, a portion of that is reserved for these people contributing their computing power. Well, those are the miners. And so very early on, people figured out that the type of computing power that was being contributed was, could be harnessed in a very specific set of servers. So when you hear about Bitcoin mining facilities, all those are servers that are optimized to facilitate Bitcoin transactions. And in exchange, they get a piece of the Bitcoin that I send to you or whomever as a fee. And so that's really kind of, the crux of it. All it is, being able to send that information without having to rely on a trusted intermediary. It's distributed, so it can't be shut down. I mean, I remember this was one of the early things, people were saying, the government doesn't like Bitcoin, they're just going to shut it down. I kept saying, no, you don't understand, they can't. I mean, you'd have to shut down, 51% of the nodes, which at this point is, it's global. There's even a Bitcoin mining facility in Antarctica. And so, part of the utility, and, we talked about this with the Fidelity Digital Assets Group and a WebEx we did with them last year. A large part of the value of Bitcoin or any blockchain for that matter is that it has a critical mass of distribution. And because Bitcoin started so early and was able to spread across the globe so quickly, it was able to kind of occupy that top spot, which will be difficult to replace. So that's one of the reasons why people say, well, what about these new blockchains? And there's a lot of them being developed for specific protocols. But again, you've started to see getting enough. The issue they often face is getting enough decentralization such that they can't be shut down. And even some of the protocols these days are so-called semi-centralized and things like that. So really the genius and the utility of the Bitcoin blockchain is that it is purely decentralized on millions of these nodes, millions of these people contributing computing power on all 7 continents, and it allows us to send information back and forth without having to rely on an intermediary. And so when you think about fast forward, there's obvious implications for payments. Logistics is another use case. I mean, just anything where you want to capture data going back and forth in a distributed, decentralized way. Blockchain is a really potentially perfect solution.
At the end of the day, though, blockchain and cryptocurrency are 2 separate technologies, correct? Okay.
Yeah. So so the Bitcoin is a piece of the blockchain, but exactly. And fast forward to today, Bitcoin has obviously kind of emerged as an asset. So it represents a crypto asset, something like a currency that can be held for investment/speculative purposes. It's part of the blockchain ecosystem, but it in and of itself, powers the utility of the blockchain, but the blockchain does have a separate utility. And so there's lots of, there's the blockchain ecosystem, there's lots of, companies specializing on different types of blockchains to, facilitate very specific objectives, like, solving the payments issue is very different than solving supply chains, logistics, and things like that. And so you're seeing companies like, IBM and, Walmart and PayPal, each kind of migrate to different blockchains, depending on what problem it is they want to solve. And each one of those blockchains is either built on Bitcoin or Ethereum or something like that, but they each have a token which powers that blockchain. And those tokens have utility. And, investors, such as all of us, are now, buying and holding those tokens on a bet that the blockchain is going to have, whatever that blockchain is going to continue to have utility. So yeah, you can think of Bitcoin as one piece of the blockchain ecosystem, specifically the piece that has the value. It's like the deed to the car or something like that. The car actually drives where you want it to go, but the deed is what has value and can transact ownership and things like that, or the title rather.
All right, I want to spend a lot of time on kind of where it is today, how it's viewed as an investment, and so on. But before we get there, so that's how I want to spend most of the time. But give, if you can, a kind of summarized history of. You talked about the Silk Road. So many of us are under the perception that in the early days that Bitcoin may or may not have been used for illegal transactions, untraceable, no taxes. And if any of that's true, confirm, and then kind of fast forward with some milestones as to where we are today.
Yeah. So I just, again, I was kind of very fascinated with the economic and kind of mathematical aspect of Bitcoin. And so I remember going on the Silk Road and just seeing, first of all, I was shocked at what was for sale on there. Everything. Drugs I didn't even know existed. I was Googling, I was like, wait, what is this? And then, AK-47. So I was shocked that even existed. And then, obviously the Bitcoin at that point, the idea was that Bitcoin was this, they were trading for $2. I distinctly remember, Bitcoin was $2 on the Silk Road. And they were the arbiter of price because most of the volume back then was on the Silk Road. There was a couple of these one-off sites. There was an eBay for Bitcoin that I remember selling a textbook on. But what was interesting was back then people thought Bitcoin was totally anonymous, and you had a couple of these early programmers. There was a couple of early hacks on some of the exchanges. I mean, this is way before Coinbase, so there was even the predecessor, Mt. Gox was kind of the first one that I remember, but there were some predecessor exchanges that were getting hacked. And I remember that a couple of these kind of forensic programmers were able to trace the wallets to, not only specific countries, but groups of people that, they thought they were affiliated with. And, this was like circa 2012, 2013. And that was really a first flag that, hey, this may not be purely anonymous. So that was interesting, and then, Silk Road got taken down, I think in 2013, and 2012, 2013. And around that time, I distinctly remember seeing too, the kind of Bitcoin popping up more in a payment solution. So like I said, there was a couple of bars in Manhattan that started accepting Bitcoin. That was mainly a marketing novelty play. But if you remember back then, Overstock.com was one. The CEO's name's escaping me, but he was very bullish on Bitcoin, and he was very early in terms of accepting Bitcoin on Overstock.com. And so that was very interesting too. I remember telling the guy who first told me about Bitcoin, I said, I wouldn't be surprised if we started seeing, dedicated Amazon coins, a dedicated blockchain for things like Amazon coins, kind of these membership rewards. And so, by so that was 2012, I think, was when Overstock started accepting Bitcoin. And for me, when I became personally very bullish on Bitcoin was when in 2012, when the IRS came out with tax guidance. And that's when I distinctly remember having a conversation in New York with a very big family office, $1 billion family office. And we were having this exact conversation. He goes, well, what do you think about Bitcoin long term? And I told him, I said, the IRS just came out with tax guidance around Bitcoin, and specifically that it was going to be taxed like real estate, not like a security. And I said, that to me conveys a high level of credibility that this is going to be around to stay. They're not looking to shut it down. First of all, they can't shut it down, so they just want to tax it. So the IRS issuing tax guidance was, to me, a big implicit stamp of not necessarily approval, but recognition that this is here to stay. And that was back in 2012 when Bitcoin was still around I think under $100. So on the back of that, it started to seem like 2013, 2014, 2015, you started seeing Bitcoin be accepted on more online merchants. And then it kind of went into this speculative phase. Obviously 2017, at that point, there was a lot of interesting use cases. We started seeing a lot of, Ethereum came onto the market too. That was more around like 2014, 2015. All these other chains came on, but Ethereum was the one too, where they said, listen, Bitcoin has great utility, but it doesn't have enough functionality built into the blockchain. We need to introduce this idea of smart contracts. And that was revolutionary. I mean, the smart contract capability of Ethereum, you could see right away how that could power all kinds of protocols. I mean, it could everything from, gambling to complex insurance, instruments, securities, settlement. The smart contract capability was really, to me, that was a big, that was a defining moment that, hey, blockchain is clearly going to be a disruptive force. It's not clear what it looks like yet, but there's enough utility here that it's not going anywhere. And then, there was a speculative frenzy of 2017. At that point, it was largely, retail. There weren't a lot of institutional dollars tracking it. Bitcoin fell off a cliff in 2018, but it was during that so-called crypto winter where, I remember going on these developer, telegrams and discords and, actually, reading on these Reddit channels what the developers on these different blockchains were doing. And there was a lot of really interesting stuff under the hood. And it just seems like in 2020, it all kind of came to fruition. There was enough, it was the catalyst of, obviously the Fed printing money the way it did got a lot of people to kind of pivot their view and say, we got to look at something different. And I think that was the institutional community that said, we've crossed the Rubicon here. We need to start looking at, assets that can't be printed. Gold being the obvious poster child, but Bitcoin being its so-called digital cousin. And that seemed to usher in, a whole new era of interest in what was happening below the surface. And lo and behold, there was a ton of amazing development that had already been done over those those previous years that was just now coming to the marketplace. So if you look at, one of the most relevant metrics to look at is just, how many dollars are actually being transacted through these different blockchain protocols. And at the end of, if you go back to 2017, it was maybe in the tens of millions. At the end of 2020, it was about 3 billion. As it stands today, it's 50 billion. So that tells you that, this is exploding in terms of functionality and protocols and capabilities that have been brought to market.
There's a lot to unpack there, and I broke down like 25 questions, but I'm gonna start with the last one and kind of work my way back. So, the recent, let's call it meteoric rise in the value of Bitcoin, of course, has a lot of people talking. I think that there is, and I know you guys have invested in both. There's a correlation, not a correlation. There's a connection, maybe a distant cousin from gold to Bitcoin. Would you agree? I mean, to a certain degree. From it's a current kind of a current. Well, some Bitcoin is more of a currency, but gold at one day, years ago, was a currency. They don't generate dividends; they're just they're
stores of value.
Stores of value.
Yep.
So why? So there's going to be a multi-layered question, and I'm a wealth advisor, so I'm questioning this growth. Is it sustainable? Are we in a? You mentioned it earlier. You've taken so many of my points and just kind of threw them out. It makes everything I say now like less relevant. But I was going to compare to, the black swan tulip, back in the 1600s in Holland. If we compare to gold and look at gold's performance, it had a reasonable 2020 and a negative 2021. What makes Bitcoin so much more valuable? They both need to be mined. They're both limited. There's a finite number of Bitcoin. There's a finite amount of gold. You can mine more apparently of each. The whole mining of Bitcoin is still very confusing to me, but maybe we'll have time to talk about that. So give me some feedback on that. Are we in a tulip situation? Can Bitcoin continue to rise, and why is it doing so much better than gold?
Yeah, so it's an excellent question. I think the comparison is spot on. I mean, in gold, in many ways, to your point about gold, being a currency, I think is becoming, increasingly the case as institutional investors have started to express real concerns about fiat currency, fiat debasement. They're looking to gold as a currency, and gold has the benefit of having been around forever. Humans have been fascinated with gold, since the inception of time, basically, and so it's. Gold has always been a store of value, so it has that in its favor. But, I always like Warren Buffett's quote where he says, if you owned all the gold in the world, you would basically have an Olympic-sized swimming pool filled of a shiny yellow metal that did nothing. That's exactly as you said, it pays no dividends, doesn't represent an ownership in a company or anything like that. And, so when you compare it to, something like Bitcoin, I would have said back in 2017, I would have said it's a lot more like tulip mania, because it's not clear that these use cases for Bitcoin have really been worked out. There's a lot of promise here, and I'm using Bitcoin generically, Bitcoin, Ethereum. There's a lot of promise here back then, but we really need to see its capability proved out. We need to see scale. We need to see more than just a couple of interesting protocols sending a few $1 million back and forth. We need to see billions of dollars solving real world problems. That's where we are today. So that's why I would say, from here, I think it's impossible to call a price target, but this is, Bitcoin at $50,000, $60,000 is very different than Bitcoin at $20,000 in 2017, because these use cases that it can now power, that it is powering, are just manifold. So the opportunity set, ironically, despite the higher price, the opportunity set is multiples bigger for Bitcoin and blockchain in general. Now, what's interesting, back to your point about kind of how it interplays with gold, there's always a question. We talk about this with some of our bigger institutional clients. Is, I was asked this question yesterday. Do you think, dollars are coming out of gold and flowing into Bitcoin? It's tough to get a read on that. Gold has had an interesting kind of metamorphosis over the last few years. For the longest time, the largest marginal buyer of gold was basically women in India buying it for jewelry purposes. Now all of a sudden, ETFs, which exploded in their own right with this active to passive migration, just very recently became the largest marginal buyer of gold. So that's, suggesting that, a lot of, retail dollars, institutional as well, but a lot of retail dollars are flowing into gold. And then central banks. It's no secret that, China and Russia are ramping up gold and selling treasuries. And so, it's interesting that I think a lot of that will also find its way into Bitcoin. You've kind of got a bifurcated investor base of people that really like the blockchain and, are probably going to start to invest in, some specific tokens that power kind of certain objectives. And then you've got other people that say, I own gold. I'm going to take a piece of my gold allocation and, put it into crypto, because it's the digital gold. And the last thing I'll say about that too is, as we've talked to clients, it seems to skew younger. The younger generation. We had this conversation actually in an advisor's office a couple of weeks ago, Ben and myself, and the guy said, I like gold, but what if I have to, leave the country? And this was a young, 20-something guy. He's like, he held up his Ledger wallet, his hard wallet that had his Bitcoins on it. He's like, with this, I can put it in my pocket, hop on a plane and go. Now, why he would need to leave the country, I don't know. I didn't ask, but with Bitcoin, he can do that. And I think that's the point, though, is it's potentially the digital gold for, a different type of investor or a different cohort. But I think you're spot on with the comparisons. I mean, I think they're very close cousins from an investment perspective.
Yeah, that's why I'm having such a hard time with the difference in values and the difference of return of investment on the two.
Well, yeah, I mean, it's a good question. Gold in particular, again, gold's been kind of fascinating this year because, gold has always kind of tracked real yields, which isn't surprising. As the opportunity cost of, back to Buffett's point, if gold doesn't pay a dividend, and this actually reminds me, I had a conversation with a Swiss guy a couple of years ago, and he's very anti-gold, hates gold. He's of the Buffett camp that doesn't do anything. And all of a sudden he said, yeah, the family office that he works for is having trouble getting vault space in Switzerland to store gold. And I was like, what are you doing buying gold? He's like, listen, he goes, here in Europe, rates are negative. He goes, so now all of a sudden gold technically is paying a dividend because the storage fees are less than the negative real yield. And, that's driving, that drove a lot of influx into gold. Recently we've seen that decouple a little bit, and that's kind of an interesting phenomenon. And back to your point about how that plays in with Bitcoin, I think, Bitcoin is still kind of the new kid on the block. There's a novelty factor, of course. People are getting excited. One of the things we do is scrub social media for sentiment, just so we can understand, what the conversations are happening around Bitcoin. And, after the Tesla tweets or after the PayPal tweet or Square and things like that, there's a huge euphoria kind of around, Bitcoin and, getting in before it hits all-time highs. And so that's powering a lot of it. But, again, it's, one of the last thing I'll say about this is, one of the appeals from an investment perspective of Bitcoin is that the blockchain, because it's decentralized, you can see a lot of information about what's going on. Unlike exchanges where there's dark pools, you can't see order books and things like that. What happened with Robinhood, shutting down GameStop, there's decentralized blockchain-powered trading protocols, which are up and running, have hundreds of millions, if not billions of dollars flowing through them. And they facilitate the same stock trading that something like a Robinhood could. But because they're decentralized, there's nobody behind there, throwing the switch saying, wait a second, you can't, buy and sell these. And so, when you look at that, there's, back to my point about what's unique about the blockchain is there's more perfect information. So you can see, where the supports and resistances are. You can see where miners are selling. You can see where the institutional buyers are buying at what level. And then, one of the things we like to look at is when these large blocks of Bitcoins are being purchased, and then when they're moved off the exchanges into so-called cold wallets as a safety mechanism, that presumably represents that they have no intention of selling them anytime soon. And so when we're looking at these levels, and that's one of the things we tell our clients is, we're still in what appears to be a very structurally bullish period for Bitcoin. That's not to say there's not going to be corrections as with any, risk asset. And again, if you look back at March 2020, that was an interesting period because Bitcoin sold off with, equities and in many cases that was, I think, a good, corroboration of the fact that Bitcoin was now a fungible asset. It was actually becoming institutionalized because it was presumably being liquidated to meet things like margin calls. But anyway, that's a long-winded way of saying that, this time is different because, we have greater visibility on in terms of who's buying at what prices and what are they doing with them? Are they leaving them on exchanges? to try and make a quick buck, or are they taking them off, storing them? And so, the setup that we have now is longer term, much more bullish than it was in 2017.
So you started this whole this bit of the conversation by saying where there's a bit of a euphoria. You know when there was another time when there was a lot of euphoria? Tulips. We're going to get into your guys' strategy, which actually your strategy works whether there is a euphoria and it's a tulip situation or not, because I like the way you guys do what you do. But before we get there, last thing. So I was going to cover like myths, like Bitcoin myths, and a couple you've already covered, of course. So is it illegal? That, I mean, a lot of people have that sense, and of course it's not illegal. Is it traceable or anonymous? You've now indicated that is not the case, correct? Anyone who owns Bitcoin, there's someone who knows who owns?
So they can't necessarily. So first of all, anybody in the U.S. that owns Bitcoin at some point, unless you went, and I remember early on in Craigslist, you would see these Bitcoin swaps before Coinbase existed. You would see these kind of barter, like, hey, I've got a Bitcoin, I want to buy, a Mac computer. Let's meet up at a cafe in Brooklyn, and like we'll, transfer the Bitcoin, you give me the computer. And people were doing that. So, theoretically, if you did that, the wallet is public, your wallet address. But to the degree that you could, make sure your wallet wasn't connected to you digitally, then technically it is anonymous. But any U.S. investor is at some point transacting fiat for Bitcoin through a Coinbase, through whatever. And, so that for all intents and purposes, it's not anonymous. Right. And again, if, there's other options. If you're worried about that, then you probably already know, how to stay
all right.
anonymous.
So I have another myth, but I just want to make sure everyone understands what a fiat is, which is just a traditional currency, right? Like cash, stock. Okay.
Exactly.
Okay. So I'm willing to bet 80% of the public, if not higher, feels or thinks that you do not pay taxes on Bitcoin. That's one of their motivation in buying Bitcoin. So address that.
That should not be a motivation for buying Bitcoin, because that
is not true, right?
The IRS is coming down to that. I remember. I mean, I sold a bunch of Bitcoin in
that's right.
In 2017, and the accountant I was using at the time was like, "We don't know what to do about this," and I'm literally forwarding him, and I'm like, "I want to pay taxes on this. Like, the IRS said it should be real estate. Just I think it's long-term capital gains. Like, let's do it." And the IRS is cracking down on that. And again, it's not unlike, legalized marijuana or gambling or something like that. If it's going to happen anyway and they can tax it, why not? It's basically free money for the government. So do not buy Bitcoin expecting to not pay taxes, because those penalties will ramp up quickly.
All right. So last thing, you've addressed a little bit kind of here and there, but let's talk about the risks involved. One of them could kind of maybe fall under the myth category, is, I forgot what it was going to be. I'll remember, so talk about some of the risks.
Well, like a lot of people question, well, how do I know people won't steal it? They're uncomfortable with the idea of like, I own a bunch of ones and zeros that's distributed across the world. How do I know it's not going to be stolen from me? And so, there's been a lot of these high profile hacks. So what I've always said is, and from day one, I mean, this you could see this was going to happen on exchanges. And this is exactly why, going back to my point, where you can see on the blockchain, you can see wallets transacting, moving Bitcoins from addresses that are known exchange addresses into cold wallet, because the exchanges can be hacked, much like a bank can be robbed. But so when and nowadays, firms like Coinbase have options where you can put your Bitcoin, you can deposit dollars into Coinbase, you can buy Bitcoin on their exchange, and then you can either hold it in that trading account or you can move it into what they call their vault. And their vault is a cold wallet. So what that means is that's the equivalent of like a USB drive, just like in that 20-year-old guy's pocket, except it's in a safety deposit box. So it's not connected to the internet, and they even have a fascinating set of protocols around that. But it's unplugged, it's not connected to the internet. And so for somebody to steal that, they would literally have to physically break into that vault, steal that thumb drive, and then they would also have to have your private key. So at the institutional level, people are often shocked when, we go, and I had a conversation with the head of a very big US bank whose name we would all know. And he was saying the exact same thing. And I said, no. I was like, talk to these guys. They'll take you through how they do it. It is much more secure than you think at the institutional level. So again, if you're leaving your coins on an exchange, then those exchanges can get hacked just like any website can get hacked or any bank can get robbed. But if you buy your Bitcoin and then move it into a wallet, of which that capability exists kind of categorically now, it's pretty tough to steal those.
All right, so this was my last myth, which is also a / potential risk. You forget your password, key, whatever you call it. What I have heard is you're done. You're done. Are you done? Is that true? That's not a myth.
There's horror stories. You can read about them. I have, 2 buddies for whom this has happened, and you are done. So the best example is I think it's in Germany. A guy tossed out a USB. He was a programmer who did a bunch of early work for Bitcoin, thought it was worthless back when it was a couple dollars or whatever. Through the USB drive or the computer or whatever, and now he's offering a $70 million bounty to the town to help him, go to the dump and dig up that computer because it's 200 million of Bitcoin.
The bounty is 70 million.
Yeah, or 70 million pounds or euros, whatever it is. Yeah.
Wow.
So no, but that is a non-trivial risk too. I can, it's happened to me. Fortunately not with Bitcoin, but with another smaller coin. The computer burned out, and I didn't print out, the credentials, the private key, and save it like I should have, and they're burned. Fortunately it wasn't 70 million or anywhere near, but that is a risk. But again, that's less of a risk when you interface now with, firms like Coinbase. Again, I keep referencing them, but they do a really good job of making it very easy to buy Bitcoin. And that's who we use to buy Bitcoin, or Grayscale for that matter. Grayscale is the publicly traded trust that basically all they do is buy Bitcoin. They take care of all those issues for you, but that's a real issue.
All right. So we are technically out of time, but I'm going to push it just a few more minutes. So any additional risks that our listeners should be aware of, and then we're going to get into what you guys and how you're doing it.
Well, the last one is just the volatility, and that's something we tell people. Look, Bitcoin is no stranger to 90% drawdowns. And what I always tell people is, it's one thing when you look at a chart and say, I could endure that because it's up, a zillion %, and I'm going to buy a Lambo and But when you're living through a 90% drawdown, one of my you made the point about the tulip craze. 100 years later was the South Seas bubble. And one of my favorite anecdotes from that was around the time of Isaac Newton. And he himself lost a fortune betting on the speculative mania of, the South Seas bubble. And I think, none other than John Maynard Keynes, the grandfather of macroeconomics, said not even Isaac Newton was immune to, the greed and fear of, the FOMO factor, so to speak. Yeah. And so the reason I mention that is because we always tell clients to think about the math of drawdowns. When you're down 10%, you only need to be back up 11% to get back to break even.
Right.
When you get down to 50%, you got to double your money.
Yeah.
100%. And then God forbid you're down 90%, you've got to hit the lotto to get back to even. And so, Bitcoin is no stranger to the 50 to 90% drawdown range. So the ball is real.
So thanks for sharing that. All right, so either Ben, tell us and tell the listeners, what I guess you can't tell your secret sauce, but what it is you do and how you are successful.
Yeah, so, excuse me. So for us, what we're trying to do is make this more investable for the common person. So the common investor is going to, like we talked about, go through an 80%, 90% drawdown and say, I'm out. We've all seen that chart where it goes up, greed, you buy more, it goes down, fear, you sell, and repeat until broke. So really our aim, and what we've been doing the last few years for professional investors, is really just take an approach designed not necessarily optimized to have the highest returns all the time, but optimized to keep you in the game. Optimized to not suffer these big drawdowns, because if we can go from say a 70, 80% drawdown and reduce that to 20 or 30, well, now you can spend a lot more time compounding instead of catching up. And then over time, if it's a marathon that we're running, you should win the marathon. So that's ultimately, from a high level, what we're trying to do. I'm sure Ben could say it a little bit more eloquently than that.
No, that's basically it. Is just trying to bring the volatility of this asset class, into something that's just a little bit more manageable. So even if it's a tiny position, 100% annualized vol is just, it's going to present a lot of emotional headaches. You're going to be, people are going to be worried about it. If it can look more like a, commodities complex or gold, I mean, that's how we like to think about it, is if you can systematically reduce the vol of crypto to something more like a gold, it's easier to fit into more portfolios. It's more tenable. We think it's just a smarter risk to take longer term.
I think an important point to make here is that we're not just, staying up all night looking for Elon Musk tweets to decide whether to get in or to get out.
Yeah.
It's an approach driven by big data, by academic and empirical evidence. So we're not up all night looking to see, all right, should we get in or should we get out? We don't wake up one morning and think, oh, today's probably a good day to get out because it seems like it's been on a good run up. It's all an academic rules-driven approach. By the way, this is all stuff that we learned on Wall Street, stuff that we applied to different asset classes that works really well for something as volatile as Bitcoin.
Right. And I think it's worth sharing that you guys are quant-based, right?
Correct.
Yeah.
Correct.
Very good. All right. In close, if you've listened to my show before, I have a final thought question, and that is, what is your ultimate lesson learned? And I will say, as just financial professionals, you can use your current career or anything you learned over your years.
At least for me, it's how important the psychology behind all these types of things are. We've all seen the stories of the Bitcoin millionaires here and there. How many of those folks do you really think just held on and didn't sell the whole time? Mm-hmm. How many of those folks do you think, sold at the bottom when they could have held on? And I think that whether or not you're talking about Bitcoin, whether you're talking about gold, whether you're talking about stocks or any of these other things, as humans, our fight or flight mechanisms are not really designed for investing. In fact, it's quite the contrary to that. So if we can put rules in place and guardrails around the things that we're doing such that we don't fall into those traps, these behavioral biases that we have, then ultimately you can have a much better result over time. And the biggest lesson that I've learned is I live in that. I do that every day for a living, yet I still find myself falling into some of these traps at times. They're just ingrained into us. And I'd make the argument, maybe we save this for another podcast, but this is how we survived. This is how we made it over Neanderthals or any other species out there, is we had these fight or flight mechanisms, but they don't work great for investing. Yeah.
You hear that, Danielle? We got another podcast, fight or flight, Neanderthals. Anything from you, Ben?
I mean, I would echo that 100%. It's the behavioral psychology is the investor's biggest enemy. And that's why I like that Isaac Newton anecdote, is because it's not a function of intelligence, it's emotional IQ. And the best way to mitigate that is just have a set of rules. And that's why we like the systematic process, is because it's a set of rules. You can set it and forget it. And, we don't have to be looking at the price of Bitcoin or anything else for that matter all day, every day. It's, let the rules work for themselves over time, whether or not it's trading an algo stock or, a person's financial plan for retirement.
Yep.
It's all the same. Rules equal freedom.
Couldn't agree more. Thank you. Ben, you want to give people an idea how to learn more about you?
Sure. Best thing you can do is go to www.idx-us.com. That's a dash like a minus sign or a hyphen. There's a ton of information there. Another great resource for folks is if you want to go to learn more about this particular strategy that we're talking about, www.idxinsights.com/coin. That'll get you right to the model page. There'll be FAQs, there'll be charts. There'll even be a link to the index that is priced by Standard & Poor's. This is the same S&P 500 Standard & Poor's. So take a look at some of those websites. And if you got any questions, please feel free to reach out to us.
Awesome. Well, thank you both for taking the time. Thank you. It was very, very educational, and hopefully the listeners will think the same. Thank you.
Thanks, Bart. Appreciate it.
Sure. And we look forward to being back in the studio again next week. Thank you all for listening. Cheers.
Tune in next week for the latest edition of the Zandbergen Report, Tuesdays at 2 p.m. Catch up on our recent shows by visiting podcast.bartzandbergen.com. The Zandbergen Report is also available on iTunes, iHeartRadio and Spotify. Interested in being a featured guest on our show or have a question you'd like to hear us answer? Email podcast@bartzandbergen.com. The contents of this podcast episode do not constitute an offer of securities or a solicitation of an offer to buy securities and may not be relied upon in making an investment decision related to any investment offering Access Wealth Management LLC, an SEC-registered investment advisor. Access does not warrant the accuracy or completeness of the information contained herein. Opinions are our current opinions and are subject to change without notice. Prices, quotes, rates are subject to change without notice. Generally, investments are not FDIC insured, not bank guaranteed, and may lose value. Brokerage services are offered through Tessera Capital, member FINRA.